Joining us now, Dana Daria, co-CIO at InvestNet, and Gaurav Malik, chief portfolio strategist at State Street Global Advisors. Gaurav, I'm just going to start with you because when I was reading, some of your comments, I just felt kind of okay. I think that at this point you have some metrics that you use that indicate risk. And even though we're in a time of the year where we worry about October lows and, a fall swoon, your risk metrics are not elevated at this point. Is that correct?
That's correct. Yes.
That's interesting. So no imminent break or even 10% correction in your view?
No, we don't see that. Honestly, there's a lot that's already been said about peak momentum occurring in growth in the U.S. But remember, from a stock market perspective, peak momentum growth does not mean peak earnings growth, right? And that's where we're looking out for. And in an environment where we don't see bond yields going much higher than about 160, 170 by year end, and no higher than perhaps 1.9 or 2 by the time 22 comes along. I think still in that environment with the kind of growth we're seeing, you want to be in risk assets. And we're holding pretty oversized weights in equities and commodities with that expectation. So corrections are possible. To be honest, our target for S&P was in that 4550, 4600 range. So we're close to that target. So I don't see much upside occurring. But then again, we don't see that same downside scenario being played out.
Kind of, you're looking, it's what's staring us right in the face, I guess. And that is, still pretty friendly yields. I don't think you like bonds at this point, obviously, but you like U.S. stocks, European stocks, and commodities. And it's just, you look at the environment, COVID or Delta eventually probably will wane at this point. What about inflation and taxes going up? Any of those things worry you, Gaurav?
Yeah, I think it's some concern around inflation, but I wouldn't say over concern on that front. I think when we step back and think about COVID, everything that you were talking about, U.S. Steel right now building a new factory, put in context the fact that we've seen significant supply chain bottlenecks. What that means to us is corporations with cash on hand are likely to make more investments in capex. Those capex investments means that certain segments of cyclical industries, so you pointed about Europe, that's the reason we like Europe, industrials in Europe tend to benefit when those capex cycles come up. Banks have been doing reasonably well. Yeah. So I would say, on balance, not as much concerned about inflation, keeping an eye out for it. But this combination of barbelling between the growth you can get in U.S. and then this cyclical exposure, cyclical recovery on the back of what's going to be continued spend as we look to release some of these bottlenecks keeps us positive in Europe.
Dana, that plays into one of your themes, and that is if you do want to play the whatever the government decides to do, that green investing might be a beneficiary in that infrastructure plan.
Yeah, no question. And we've known that for a long time. So really what it boils down to is how much is that it's kind of already priced into the market prices. But if you're interested in the ESG space, we certainly see a lot of the flows going to passive products, to low tracking error products that probably don't stand to benefit as much from what we think is going to be, transition risk and physical risk that the market has to contend with going forward. When you look at this infrastructure package, of course, there's a lot in there for renewables, a lot in there for electric vehicles. So certainly if you're interested in that space, those are thematics that you would want to probably be looking at.
Are you as calm about the equity markets right now as Gaurav? You seem to think maybe there's a reason it's listless. We had huge gains in the first half of the year. There's concerns about the debt ceiling. There's inflation is probably not transitory, maybe in your view. So, do you think the upside is fairly limited here, and you need to be selective? Is that what we take away from the?
Yeah, I think if you're an advisor kind of looking at your client's asset allocation, now is a time to make sure that the risk tolerance is right? It's, there's a lot that the market's going to have to contend with at the end of the year. Notwithstanding, we are seeing, mixed economic data, but at the end of the day, we know that the market's going to have to deal with the debt ceiling negotiations that are coming, potentially tapering. that's likely to be coming the end of this year. Obviously, who knows what happens with the COVID variant. So it's not to say that things don't necessarily, can't work out well. But if I'm an asset allocator, I'm certainly looking at this now and saying, is my risk tolerance right? Am I diversified well? Am I in the right posture for what could be some volatility coming forward?
Shepard Smith here. Thanks for watching CNBC on YouTube.